Is fear hindering your city's investment opportunities? Are you relying on your local government investment pool to earn interest on your reserves? Some perceived risks of investing are mitigated pretty simply by implementing a disciplined plan. It's up to you to make informed investment decisions. So in this video, I want to explain how to protect taxpayer money from the risks of interest rates fluctuating. If you think rates are going to go down, now might be a good time to get started. Often people associate yield with risk when thinking about the stock market. However, city treasurers don't invest in stocks. City reserves are usually invested in debt issues. Are those risky? Decide for yourself. Treasury bills or treasury notes are issued by the federal government of the United States. Corporations can sometimes go bankrupt, but the federal government can't default on its debt. If you haven't learned how to buy your first treasury because you're afraid investing is risky, please consider how investing in treasuries can actually reduce some risk. For instance, if you buy a 5-year treasury with a 3% yield, you have certainty of earning that yield for the entire 5-year period. Compare that to investing in a variable rate local government investment pool. If you think rates are going to go down, investing taxpayer money in a treasury will lock in a fixed yield. Government-sponsored enterprises, or GSEs, are familiar names to you. FNMA is commonly known as Fannie Mae. FHLMC is known as Freddie Mac. These are backed by the federal government as well. A few years ago, there was some debate about whether that backing was explicit or implicit. In 2008, though, that debate pretty much ended. Investing in these agencies, Federal Farm Credit Bank, Federal Home Loan Bank, Freddie, Fannie, and TVA, brings certainty and safety similar to treasuries. Agencies, like treasuries, are highly liquid, allowing for easy conversion to cash when needed, and they deliver fixed yields until maturity. One thing to know is that some agency debt issues have call features. In order to maximize your certainty, buying non-callable agencies is what will give you virtually the same safety, liquidity, and yield you get from a treasury. If someone tells you agencies are more risky, so have higher yields, look to see if maybe that's not just because they're talking about callable agencies. If you predominantly invest your city's reserves in your local government investment pool, be sure you look into its weighted average maturity. If your pool buys investments with a maximum maturity of 1 year, then on average, the pool may have a 6-month average maturity. If rates go down, your money on deposit earns less interest in a hurry. Diversifying your own portfolio by maturity date is key to managing risk and smoothing out yield fluctuations. That's what minimizes reinvestment risk, helping to smooth the average yield of your portfolio. For instance, if you anticipate rising rates, you might start buying investments with shorter maturities so you're not locking in as long what you consider a low rate. If rates are expected to drop, you might purchase longer maturities to lock in rates longer. If you buy a 5-year treasury at 4% today, but your pool only buys 1-year maturities, they might get a 4% today too, but next year they might only get a 2%. That's where you'll be happier having locked in your long-term yield. Don't let the fear of risk prevent you from learning how to invest. We don't know rates 2 or 3 or 4 years in the future. So what do? We diversify our portfolio by maturity date, subjecting only one small piece at a time to any given maturity date in the future. By diversifying maturity dates, we mitigate reinvestment risk and we smooth the average yield of our portfolio. If you think rates are going to go up, you might diversify over 3 years of maturity dates. If you think rates are going to go down, you might diversify your portfolio across 5 years. Managing your treasury fear requires understanding risks and making well-informed investment decisions. Don't fail to invest because you think investing is risky. Instead, reduce the risk of your city's investments by diversifying maturities, smoothing your yields, making them more predictable and budgetable for several years to come. We will all probably need to keep plenty of liquidity in our local government investment pool. That's where the ebbs and flows can be absorbed, still earn a variable rate of interest. But investing in treasuries and agencies keeps your taxpayer principal safe and can lock in interest rates that won't change. I hope this video has given you some ideas to invest with confidence. I'd appreciate your feedback and comments as I consider future content, but I really hope this video reaches others who need it. In finance, our success lies in helping others succeed. This video aims to help you because it's your efforts in managing your city's investment portfolio that will contribute to the financial success of your city and make it a better place. Thanks for watching.